Canadian banks are in trouble as private sector debt and household sector debt has absolutely skyrocketed and peaked. And it is really leaving these banks in a precarious place, teetering on the edge of a cliff. So let's get right into this. TD and Royal Bank, Canada's about to implode, the sequel. Basically, we went through this actually before. This was a great, well-balanced article, I think. But he did this before and we went through it on this channel. And this is like the second edition, I guess, because he got a ton of pushback from people. And we're going to go through what's going on because I agree with a lot of what's said in this article and what this guy Jordan has written here, which is absolutely true. He's outlining the huge risks in the Canadian banking system, which are just so large that I don't understand how people can ignore them. But if a banking institution just keeps on increasing their dividend, investors just love it. They just love it. They cream their shorts over it. So anyway, it's just absolutely insane. While investors around the world have their eyes squarely on inflation, the global debt bubble looms in the shadows. Canada's private debt has ballooned to unprecedented levels. Consumers have borrowed against the inflated equity in their homes to secure lines of credit and even buy second and third homes. And he's basically talking about the dominoes stacking up there of people leveraging one home to go out and buy another, to go out and buy another. Like they'll just leverage one, leverage the other, and just it continues onwards. And a lot of these people also commit fraud. They want to put 5% down. A lot of them probably can't afford to put 20% down. So they're taking 5% from their home equity. They're putting it down. We've said before how on this channel, banks don't give an F where the money is coming from. As long as you can show 90 days worth of bank statements, they don't care. They don't really look into it too much because they just want to write up that loan so it looks good on their earnings and they get those bonuses all the way down the chain within the bank. So let's see what's going on. Let's also first take a look at this chart, which is Canada private debt to GDP. You might be asking, what is private debt? Well, essentially, this is just debt held by corporations and businesses that people depend on paychecks for, and they are just in so much debt. And the other worrying thing about this chart is if you take a look at it, you can see how it's actually peaked. There is a clear peak there. So that's not looking good because as you can see before in the past, there hasn't been a peak here before. We've just got this peak right now. So that's not looking good. And if you look over to the US chart, you can see that it's peaked indeed there too. But it's around 230, 235 on the index, whereas Canada is coming down from over 300. And the US at the peak of 2008 was around 230. Well, Canada has just inflated to insane levels, and now it is just coming back down, and it looks like it's peaked, and that is not a good sign for the future because this private debt bubble is so huge, and people don't realize how private sector debt was really lower, so much lower before the GFC, and that was luckily how Canada managed to scrape through without so many job losses, was because this private sector debt was lower, and basically businesses took on lots of debt during the GFC. They inflated that bubble further, kicked the can down the road, and now you see where we're at now, and we're looking at one hell of a disaster for unemployment because the debt servicing costs have absolutely skyrocketed. It takes time to affect the business. And, you know, a lot of businesses will be going in to do their books for year end, and they're going to look and they're going to say, hey, we got to cut costs going into next year. And they're going to look at laying people off essentially. And, you know, this is why these rate hikes, they take time to have an effect, but businesses' expenses are rising. Demand is coming down because essentially that bubble is bursting on the demand side. So demand for their products and services is coming down. And considering how many businesses revolve around things like the housing market in places like Toronto, it's just absolutely mind-blowing the job losses that we could see in financial centers like that. It really isn't something to think about lightly. So we'll dig into why the CMHC and investment banking offer little protection. So 5 months ago, we wrote the article, TD and Royal Bank, Canada's about to implode. In the article, we argued that Canadian banks are priced too richly given where Canada stands in the debt cycle. Canada now has a private sector debt to GDP ratio of 230. And again, you can see on that chart, but that's literally what we just went through. For reference, before the American financial system melted down in 2008, the United States had a private debt to GDP ratio of just 170, and Canada is at 230%. So that shows you how much bigger this debt balloon is. And really, it's just it's just all this can-kicking, low-interest rate policies that have essentially created this absolute disaster. And, you know, it's institutions like the Bank of Canada being used by the government, like the Trudeau government, has essentially used the Bank of Canada to keep rates low since they got in office way back in 2016. So, you know, it has really been going on for longer than just the past 2 years. And that's what I think people don't really understand. They think it's just these 2 years that we're talking about. It is much, much longer than that. It goes way back to 2008. And it's just kind of crazy. So it says right here, when a country's housing market goes straight up for 30 years, people get really crazy. I mean, that is exactly the reason why their name, Market Mania, that's why I called this channel Market Mania, is because 2021, when I started this channel, we were in a mania. It was like people were literally insane. And towards the end of 2021, we started to hear a lot of people say, well, housing prices can only go up, they can't go down. And it was when I started to hear that being peddled around, I thought, wow, this probably is the top, because it's when you hear stuff like that, it's when you listen to what people are saying, the sentiment, because it's so important, because eventually when people get to that point, that's usually the end. That's usually when you're at the peak. So there are mom and pop real estate investors, towns full of empty vacation homes, and parents co-signing on mortgages. We talked about how they're doing that with home equity lines of credit and all this other just garbage. You wouldn't believe who would lend out, not even lending out their equity. They're gifting away their equity. I mean, it's just mind-blowing. The lack of financial common sense, essentially, that people have. Because I really think if you talk through these things, and even if somebody who's like 8, 9, 10 years old was watching these videos, they'd probably be able to understand more than the average person who just doesn't get it and is essentially just stuck with this herd mentality. And in some ways, I don't blame these people, because they've been manipulated by the financial media. They've been manipulated by the real estate industry, the mortgage industry, that all have financial interests in selling you products. I mean, if you throw in Canadian housing market into YouTube, how many of the people who are delivering content to you have like businesses within real estate or mortgage or the mortgage industry? A lot. It's loads of people. It's no coincidence that that is the case, guys. And I think that is why a lot of people come to this channel, because I have no financial interest in selling you a product or service, and neither am I looking to buy or sell real estate in Canada for my own reasons. So anyway, it's kind of crazy. Why rent when the value of homes only goes up? That's the mantra on the street, especially in the hotter economies of BC and Ontario. And he has nailed that to a T. Just like we said right there, it's really when you get to that you should really start being suspicious about what's going on when you start to hear people. And we really heard that to an insane degree in 2021. It was like, it can only go up now. So kind of crazy. Lots more to dive into here. So not only do Canadians speculate on real estate, but they do so with variable and 5-year fixed loans, and they borrow against the inflated equity in their homes. The latter is known as a home equity line of credit. Essentially, people use their home equity to secure a loan to buy an RV, boat, furniture set, you name it. It seems to us that this row of debt dominoes can collapse if interest rates spike too high, and Canadian banks are not immune to eating huge losses if it does. I mean, there is so much to dive into there, and I was really thinking about over the course of this week how all these things like home equity lines of credit have probably driven up inflation a lot. I mean, think about it. Would there be so much of a demand for things like boats and RVs if people couldn't just extract the money from their home? Probably not. So it's kind of course, they would create financial products so you could get into these things, because that's what the economy's all about in Canada and the United States. Just get more into debt, just get more and more into debt, so that it's like somebody's got their knee on your neck and you can barely breathe, and that's why people get depressed and anxiety, and it just causes, it's just a nightmare. Who wants to live where you're just paying off all this debt, you can't even afford to go on vacation? I mean, that's not life. What is that? And the funny thing is, you go to countries like Mexico, you go to countries in Central America and Asia, and you talk about this to them, and they're just like, what? Them to try and get their head around what goes on. But they don't understand. You see, they see the rich people coming off the plane from Canada who look rich and spend all this money. But little do they know, they're getting it all from these financial products, and they're in an insane amount of debt. Most people's net worth is actually negative when you take into account all their debt. And I think a lot of people think mortgage debt is not debt. It's called a mortgage. So again, these euphemisms, it's called a mortgage, so that must mean it's some good type of product. No, it's just debt. It's just another loan. Yes, it can be good if you invest properly, but if you're just buying a home, that's not an investment. I don't really class that as an investment. That's a place that you live, even if you're buying or renting. But people don't seem to connect the two. I know there's pros and cons with each, and I'm getting off on a tangent here. So kind of crazy, a lot to say there. CMHC, the CMHC is a joke. I'm really gonna have to contain myself here. Many point to Canada's CMHC mortgage insurance as protection against the housing collapse. CMHC is a government agency that insures many of the mortgage loans made by chartered banks like TD and Royal Bank, but CMHC has highlighted some concerning trends when it comes to this. As of the first quarter of 2021, only 35% of outstanding residential mortgages extended by chartered banks were insured. This share was over 60% in 2012. So that kind of shows that something shady is going on there, in my opinion. Why don't they want to insure it with CMHC? What's going on there? We don't know, but it could be that they're rehypothecating these mortgages, creating all these different financial products for things like pension funds to essentially speculate on and with. So it's kind of crazy. CMHC is a joke. They are an institution in Canada that essentially prides themselves on making housing more affordable, when actually they do the complete opposite. And this is funded by the taxpayer. This is a taxpayer venture. Taxpayers' money backing up all these mortgages and bad loans. It is almost criminal to me that this is allowed. I would love to see the CMHC scrapped. I mean, there's so many things I would love to see just scrapped. People think it helps them get into a house because, oh, we can just put 5% down. But no, it doesn't work like that. Actually, if people had to put 20% down, that might actually drive down prices, believe it or not. And then you might be able to afford the home as well. Plus, you're taking less risk if you can put that money down. Now, of course, in 2021, as they pointed out in this article, a lot of the uninsured mortgages, they went up like a lot more of those were being written. Why is that? It's because people were just extracting their equity and dumping it into other real estate ventures, vacation properties, second homes, Airbnbs. I mean, people are just going to get wrecked. They're going to get demolished in this. And I hate to be so blunt about it, but people have just been naive over the past couple of years to think that this thing is just going to continually inflate forever. Just do the math on it. Plot out how much a house would be worth if it continued up at the same rate it has the past 12 years, like it has in Toronto and Vancouver. You're talking insane amounts of money that is not going to be driven into that. And yeah, it's just kind of insane. And I would urge you to go do that because it's kind of interesting. So anyway, corporate debt levels. It's not uncommon for Canadian corporations to carry debt loads representing anywhere from 10 to 20 times their net income. BCE Inc., Enbridge, and Fortis are all excellent examples of this. Not only do Canadian corporations carry dangerous amounts of debt, but they dilute shareholders to maintain their stretchy dividend yields. I mean, that's almost criminal in itself. Canadian banks often have a plethora of risky options when it comes to their corporate loan portfolios. And just think about the commercial real estate sector and how that's looking. And it's just kind of insane. And then it goes through their earnings here. And it says, we have some key takeaways. First off, TD has more US exposure than Royal Bank. This could turn out to be a net positive for TD. I agree. Second, both of these banks earn a lot of money from wealth management and trading fees. Yeah, I don't understand how anybody pays for them, to be honest. They often charge $10 on the buy and sell to buy stocks in their trading platforms. Crazy. I mean, there's other options out there. Wealthsimple is garbage in my opinion. The amount of products they have is not very many, but Questrade is a good platform. I actually use Questrade myself. I'm not affiliated with them in any way. That's just one of the brokers that I use. But I'm in a lucky position where I have more than one citizenship, so I can use different and leverage different brokers other than the ones here in Canada, which are just so restricted and so expensive because of the monopolies. And that basically just goes through their share price, and we won't go through that. But I want to show you this, and we'll kind of end here. But this is the loans to the private sector in Canada. And you can see this is absolutely just took off to the moon here, to the moon. So the amount of loans being given to the private sector, it's just going up and up and up and away to the moon. Absolutely insane. So if you enjoyed this video, you might like that one there. You might also like that one there that the YouTube algorithm recommends. Thank you so much for watching. I will see you on the next one. Please sign up for my free email list.